There is all this mess happening with the SEC and crypto is going down, the numbers are red. But there are a few winners in all of this, and Stacks is one of them. Stacks is up 11% and only Terra Classic, the remainders of the Terra Luna collapse, is performing a bit better, probably because of inherent leverage. Now, why is Stacks up? It's very hard to pinpoint. When you look at the crypto news, you see two potential reasons. So STX stands out because its offering conducted by Blockstab, the company behind Stacks, received SEC qualification under Regulation A+ in 2019. This historic event marked the first ever SEC-approved token in the United States. As a result, STX appears almost immune to the regulatory purgatory that has plagued the broader market. The second reason seems to be related to the hype around ordinals and BRC20, which is dying down though. I personally have my doubts that those two factors play a big role here. My impression rather is that there is some kind of market manipulation happening here, because most trading for STX happens on Binance. A bit of that on KuCoin, but it's really a token in the hands of CZ, and he can theoretically wash trade this token to the moon. Now, still it makes sense to have a closer look at rallies like this. And what is interesting here is that we just went above specific moving averages here. Now, these are not just random moving averages, these are back-tested moving averages. So what most people do is they simply just look at a chart, they add a moving average, and then they take maybe the 100-day. And then they say, okay, we might be bearish when we are below the 100-day, we might be bullish when we are above, and now we are bearish again. Alternatively, you could take the 200-day, right? Now the moving average is a bit further away from the price, and again, same concept. But the issue is always, what's a good duration for a moving average, right? You could simply just reduce the length here and then, for example, enter here earlier, right? The shorter the duration here is, the closer this moving average gets to the price and the earlier we would have bought here. But that also means we are exiting earlier when the price goes down. So let's say we take a very short moving average. Let's go further and further down to maybe the 50-day or so. In that case, we would be bearish for quite a while already, and we are about to break and become bullish. And that's always the problem with trading according to technical indicators. You don't just want to follow random signals. You want to have an idea of how valid signals are. How valid have they been in the past? How well does this approach in general work, independent of the moving average duration in this case? And so here is something I do regularly on this channel. I do backtests. I try to find out what moving averages work, how well do they work in general for a particular asset, so in this case STX. And so with the recent moving average backtest, we've got a data set that starts in October of 2019 and goes all the way to the 8th of June of this year. And so we can simulate what would happen according to the moving average duration if we bought just over here and if we sold just over here. What would happen if we maybe not even just sold over here, but even bet on falling prices when the price goes below the moving average? How would a performance following that strategy actually compare to simply just buying and holding Stacks over the entirety of its existence? And so in this Excel sheet, there is a macro and it simulates exactly that trading. It looks at all the moving averages from the 2-day all the way to the 200-day. And then we try to find out how good is that performance. How well did buy and hold perform, but also how well did that specific trading strategy perform depending on the moving average. Should we take a simple moving average? Should we take an exponential moving average? What should be the duration of those moving averages? All of those questions get answered with this backtest. And what we see over here in column B is the duration of the moving average. Then in C, the annualized performance of the simple moving average trading strategy. And in D, the annualized performance of the exponential moving average. You can see already when we go around this duration here, right, 40 to 60 days, this looks quite nice, quite green. Buying and holding during the time period would have given us 90% per annum. Now we do have a few trading costs here as well, so 0.2% for each buy and sell, and we do both here, right? So we buy whenever the price is above the moving average, and we bet on falling prices whenever the price is below the moving average. So we don't go in cash here, we bet actively on falling prices. And when you do that, then you get this result over here. So this chart is just a summary of this table over here. So on the x-axis, we've got the duration of the moving average, and on the y-axis, we've got the annualized performance of the backtest. And what we see here in turquoise is if we used the simple moving average, and in red if we used the EMA, the exponential moving average. And we see here the 43-day simple moving average as well as exponential moving average worked the best. So that's the best duration. But what I also find very fascinating around this is we get a result similar to many altcoins actually with the backtest of Stacks as well. We get the result that most moving averages, even after trading fees, tend to outperform buying and holding. So in black, we've got the hodl line. So this is what we would have gotten if we just bought and held Stacks. And we see if we don't trade too actively, if our moving average duration isn't too short and we get eaten up by all those costs, if we go beyond the 30-day, pretty much all the moving averages outperformed buying and holding. Only if you go too far out with the duration do you get closer again to buying and holding. Now this is encouraging because it means that in general the strategy seems to be working. The duration isn't even too important. If we backtested this and the results would simply just hover around buying and holding, then you could argue, okay, this is just random. But if most of those points are above buying and holding, this shows that crypto really moves in waves, that there's really momentum. So it really makes sense to follow the trend. If the price tends to go up, it makes sense to buy. When the price tends to go down, it makes sense to rather be bearish. So the existing sentiment has a tendency to stick around for a while. This is what this backtest is showing. And so how much of a difference does this make? Well, this is annualized, right? 90% per annum for buying and holding versus for the simple moving average, 377% per annum in gains. So because you annualize this, this is what the chart then looks like. Now this is impressive, isn't it? Like in white, we see the Stacks price, and in turquoise, we see how the capital developed following that strategy. So we moved from $1,000 to 120,000, so a 120x by following the strategy. Now with buying and holding, right, you would be starting out 200 days after the very first data point, right? We want to compare the same window independent of the moving average we take. Buying and holding would have started with 9 cents and then go to 66 cents. So 66 divided by 9 is a 7x. So we're talking here a difference between a 7x for buying and holding versus a 120x for this strategy. And what I like specifically around this is that we really gain whenever there is a bear market, right? We bet on falling prices. And if we just remove the Stacks price itself from the chart, we can see how consistent actually this increase is. So what we see over here is a linear scale. This is the exact same chart, but on a logarithmic scale. So here we've got the 10x from one another. So moving from this horizontal line to this horizontal line is a 10x, then moving from this to this is another 10x, and this is going up relatively steadily. So we've got both. We've got consistency over time in terms of performance, but we've also got consistency across the different parameters, the different length of the moving average. Now, why do I talk about all of this? It's because of this chart over here. So this is Stacks together with the best simple moving average and exponential moving average, the 43-day. And we are now just about to cross those moving averages. So this is very bullish. Historically, this is a very strong buy signal. If you're not just buying and holding, but you try to time those waves somewhat, now would be the time to get in. But of course, the general macro for altcoins currently isn't too bullish. I am very conservative with my approaches to crypto. I hold a lot of Bitcoin and I do bet on falling prices of various altcoins, but I currently don't try to pick the altcoin that might make the race. But Stacks, if you do want to pick those rallies, currently looks pretty interesting. But that's the reason here why I don't buy and hold altcoins. It's simply the volatility is so massive. Look at this, right? This drop over here was almost 93%. Even if you diversify across different assets, this is definitely a very painful move. But once you time the market somewhat, you don't have drops of 90%, right? 90% would be from one of those horizontal lines at the top down to one horizontal line below. So again, here we've got in white the Stacks price. This easily went down by one of those distances, right? Horizontal distances, 90%. And the volatility is lower for trading. And this is kind of counterintuitive, right? Most people think buying and holding is safer than trading. But if you're actually hedging against negative momentum, or if you've got specific times where you're even in cash, then you're reducing overall volatility. And so if you just look at the recent past, right, you would have sold over here, for example, and then exited that short position, moved from cash back to Stacks just right now. So an avoidance of 25% loss, or alternatively even a gain, right, if you bet on falling prices. Now, no strategy is perfect. And so we do have our fake outs. The price goes down, but still every now and then the price just jumps above and then below again. So you're buying in high in order to sell low just one day afterwards. Happened here on the 10th of March 2022. Happened again over here, right? You don't make much money buying at this point and then selling pretty much at the same point afterwards. Here, another of those fake outs. So it's not perfect by any means, but it does take advantage of these longer trends. And the trend might just be turning around again. That's what the data is showing us. Now, this is one of many backtests I've done over the years. Backtests on different trading approaches, backtests on different assets. And that's, I think, what makes this channel different from others. We only use approaches that historically worked well. And even though past performance is no guarantee for future performance, I think it's the next best thing that we have. We simply work with the assumption that psychology doesn't change too much over time. When people are down 80%, they're likely going to react very similar, no matter if this was in 2016 or in 2019 or in 2022. If an altcoin suddenly has a spike in attention, does it make sense to buy? And if yes, under what circumstances? Those kinds of structures don't necessarily change with time. And so we've done all kinds of backtests, and you can download all of those Excel sheets for the different backtests in the premium membership. There are also tutorials specifically for backtesting. How to build such a sheet, how to change such a sheet. All of this is very valuable content, and it is a proven approach that helps to ride those positive waves whenever we are in a bull market, and that helps to protect us whenever we are crashing down. Now, there's more information around the premium membership at thebitcoinstrader.com, a dedicated video on this. And the price isn't that cheap. It's $75 per month. But here's the deal. If you are not happy with the content, if you're not happy with the support in the Telegram channels, if you don't think that you get enough alpha out of this content, then simply message me in the very first week and I will refund you 100%. So there's zero risk for you. Most people that sign up, they stay signed up because they get more money out of it than they spend. But feel free to simply just try it out yourself. You can watch all the videos, you can download all the Excel sheets. The reason why most people stay subscribed is because of the community. It's because the trading opportunities we share with one another, and it's those opportunities and the timing of those opportunities that make us win over the long run. So check it out. It's thebitcoinstrader.com, 100% risk-free for you. I don't know a reason why you wouldn't try it out.